Remember, we've talked about this. We are all in what we call historic low levels of taxes today.
Yep.
And so to me, that's opportunity knocking.
Achieving financial success takes dedication, discipline, and most importantly, a plan. For over 30 years, Don Reynolds has helped savers define their needs, formulate their plans, and achieve their goals. From accumulation to preservation and protection, and through the income distribution phase in retirement, implementing the right strategies makes all the difference. Your retirement is our business. Welcome to Strategic Asset Preservation.
Well, hello again, and welcome to another episode of Reynolds Wrap. I'm Don Reynolds, and
Corey
Stilt here, a good friend and business partner. Today we're going to talk about Roth Conversions. We're big proponents of that. I'll just say that first and foremost. The way we do it is we look at income brackets.
Yeah.
And our attitude is if you're in a bracket already, you should be maximizing that bracket. It gives you what we call wiggle room.
Yeah.
Remember, we've talked about this. We are all in what we call historic low levels of taxes today.
Yeah.
And so to me, that's opportunity knocking. Where it goes from here, nobody knows. I don't believe taxes are ever going to go lower. I could be wrong. I hope I'm wrong. But when I look at what's going on in our country, I don't see that happening. And so, there's a lot of different questions, concerns, thoughts. And I guess we just want to kind of take all of that, myth, if you will, again, out of it. A Roth is simply dollars you put in after tax, and they grow tax-free. They're never taxable to you. Okay, that's the simplest way to put a Roth into layman's terms for people to understand. Now, you can do conversions. What you're doing is you're taking an IRA and you're converting it to a Roth IRA. When you do that, those dollars that you convert are taxable.
Yeah.
Now, some people say that if you convert money, you have to pay the tax dollars outside of the money you convert. Otherwise, they say there's really not value in doing it because you're losing power of time and money. I don't make that judgment call. Some people say, well, you still will be better off long-term because you got now dollars growing tax-free. And so it won't affect Social Security and all that fun stuff later on. So again, I'm not saying right or wrong to that.
Yeah, I think the key is look at some cause and effect, right? With these conversions, because a contribution is different than a conversion. And we get asked this all the time. Contribution is taking new money and putting it into a Roth. So I'm still working. I've got earned income, and I've got to at least have enough earned income for every dollar that I put into a Roth IRA, or I've got a Roth 401k at my work. So that's a contribution. A conversion that we're talking about today is taking already classified dollars that were saved pre-tax, growing pre-tax, and converting them to a Roth. So I'm just changing the title of that dollar. And when I do that, as Don mentioned, that specific year is taxable. So I think the key is that, when we're talking about having cash outside of the conversion to pay for the tax. So just say, hypothetically, I convert $10,000 from my 401k or traditional IRA to a Roth IRA, and I've got to pay tax on that. Let's say state and federal is 30% between combined state and federal. So I've got to pay $3,000 in order to get $10,000 into a Roth, because that $3,000 is tax, or that $10,000 taxable that year. So and it's $3,000 of income tax. If you've got the cash outside of it, I would say that is the best. I know, again, we're not going to make that determination. We're going to show you the cause and effect of it. If you take the conversion dollars out of that for taxes, one thing that we would want to look at is, again, that retirement analyzer program that we have, and looking at a tax analysis in there and looking at the cause and effect is, do you expect to be in higher income tax brackets later in your retirement? That's a big component to this whole Roth conversion aspect, is looking at, 5 years from now, 10 years, 15, 20 years from now, however long you expect to live in the retirement, what tax brackets will I be in going forward? And then we come back to today and we say, okay, well, if I'm going to be in a third or fourth tier of the tax system, because you understand in the United States, we're in a progressive tax system. We go through the brackets with higher taxable income. Well, if I convert today, and even if I have to take dollars out of the conversion to pay the taxes, I still will put myself in maybe the first or second tax bracket in the future, then it may make sense. Right. And again, that's the key, is to just look at the long-term cause and effect because it's not truly just a decision today that you're making. It's a decision you make today that's going to change the future and your tax liabilities in the future. So that's where you got to kind of go forward and then come back and see if that makes sense for you folks.
And then one last thing I wanted to talk about with Roth conversions, you do have a 5-year rule there. So when you convert a Roth, it's got to be 5 years before you can take it out. Now you can take principal, but you can't take growth. But then you're kind of defeating your whole purpose of doing it in the first place. So I hate to say that to people because it's kind of a double negative, in my opinion. So, but be mindful of the 5-year rule. The other thing, if you're not aware, with the laws that changed last year in 2.0 or 2.1, some call it, all IRAs, whether they're Roth or traditional, upon the passing of the contractor, the IRA holder or owner, if it's passing to legacy, in other words, not going from husband to wife, but going from, say, husband or a father to sibling, that's a 10-year rule now. All monies have to be out within 10 years of the date of death. That's new. That changed this last year. So we just want people to be mindful of that as well. Again, if you have questions about this, that's why we're here to answer. So please give us a call at 651-773-3859. Again, that's 651-773-3859. With that, we thank you all. Hope you've been enjoying the show, and maybe we'll talk to you in the near future here.
Yeah, give us a call, folks. We'll be honored to help with your questions. Have a great day.
Thanks.
Listen to more with Don Reynolds and Corey Stilp on the Strategic Asset Preservation Podcast by visiting 800preserve.com.
The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.